December 2023. A courtroom in Lower Manhattan. A man in a suit that doesn't quite fit sits at the defendant's table, hair uncombed, looking less like the face of a financial revolution and more like someone who overslept for the most important meeting of his life. The judge reads the charges: 11 counts, wire fraud, securities fraud, money laundering. And here's the thing. He doesn't flinch. He just sits there, blinking, like a man who still can't quite believe the math stopped working. The number is $8 billion. Say it slowly. $8 billion. Not lost in a bad trade, not evaporated in a market crash. Gone. Moved. Taken. Customer money. Your money, if you were one of the millions who trusted FTX, funneled into a sister company called Alameda Research, spent on real estate in the Bahamas, political donations, venture investments, and a level of hubris so architecturally complete it almost deserves its own category. Almost. This is the story of Sam Bankman-Fried. And before we get to how it ends, we need to talk about how it started. Because the ending only makes sense if you understand how good the beginning looked. You have to picture 2019. Crypto is not yet the household word it will become, but the true believers are already rich, already loud, and already building. Into this world walks a 27-year-old MIT graduate with a physics degree, an effect so flat it reads as genius, and a theory about trading that actually works. His name is Sam Bankman-Fried. People call him SBF. He sleeps on a beanbag in his office. He drives a Toyota Corolla. He talks about something called effective altruism, the idea that you should earn as much money as possible so you can give it all away. He is, by every visible metric, the anti-villain. The billionaire who doesn't want to be a billionaire. The capitalist who thinks capitalism is just a tool. And, yeah, that's the first trick. The disarmament. He co-founds Alameda Research, a quantitative trading firm, and in its early days it genuinely makes money. Real money. Real trades. There's a famous arbitrage play he runs in 2018. Bitcoin was trading at a premium in Japan compared to the US, and SBF figured out how to exploit the gap. It worked. It was unglamorous and exhausting, and it worked. He is not, at this stage, a fraud. He is a guy who is very good at math and very bad at sleeping, and very willing to do the boring thing that other people overlooked. This is the part that matters. This is the legitimacy layer. Because the con only works, it only ever works, when the con man starts real. In 2019, he founds FTX, a cryptocurrency exchange. The pitch is clean, a professional-grade platform for serious traders built by people who actually understand the market. Within 2 years, it is valued at $32 billion. Sequoia Capital invests. SoftBank invests. The Ontario Teachers' Pension Plan invests. And if that sentence doesn't chill you slightly, sit with it for a moment. Pension money. Teachers' retirement money. Flowing into a crypto exchange founded by a guy whose bedroom is reportedly also his office, located in a Bahamas penthouse shared by an indeterminate number of colleagues in what is variously described as a polycool and a work commune. Totally normal. Definitely not a warning sign. SBF becomes the face of crypto legitimacy. He testifies before Congress. He donates $40 million to political campaigns, second only to George Soros, among Democratic donors in the 2022 midterm cycle. He appears on magazine covers. He sits on panels with Tony Blair and Bill Clinton. He is the person the industry points to when someone asks, "But can crypto be serious?" And you wanted to believe it. Of course you did. Because if SBF was the answer, then the question was finally worth asking. And here's the thing about trust. It doesn't feel like a decision. It feels like recognition, like finally seeing something true. Now let's talk about what was actually happening. FTX had a terms of service. It said, plainly, that customer funds would not be used for anything other than trading on the platform. Customer funds were segregated. Customer funds were safe. This is what every user agreed to when they signed up. This is what every institutional investor was told in the due diligence process. And, yeah, none of it was true. Here is the scheme, stripped of every syllable of jargon. Customers deposited money into FTX. That money was supposed to stay there. Instead, it was quietly moved to Alameda Research, SBF's trading firm, which he also controlled, which was run by his on-again, off-again girlfriend. Alameda used the money to make trades, some of which lost. Alameda used the money to invest in other companies. Alameda used the money to buy a $35 million penthouse in Albany, Bahamas. And Alameda used the money, this is the part that requires you to stop and breathe for a second, to post collateral using FTT, a token that FTX had invented itself, which meant the entire balance sheet was essentially a house of cards built on a currency FTX could print whenever it needed more cards. That's it. That's the whole thing. The financial equivalent of "trust me, bro," wrapped in enough complexity that the people who should have caught it kept getting lost in the wrapping. The investors were not stupid. Let's be clear about that. A hedge fund manager who runs billions in assets is not unsophisticated. A pension fund administrator who signs off on a 9-figure allocation has run the numbers. The problem wasn't intelligence. The problem was that the numbers they were given were the wrong numbers, produced by a system deliberately designed to show the wrong numbers, audited by a tiny firm in a strip mall in suburban Ohio that, and this is real, had never audited a company of this size before. If you'd known that, you might have asked more questions. You'd be right to. But you didn't know. Nobody outside the inner circle knew. And the inner circle, it turns out, was very small and very quiet. There were people who suspected. There always are. As early as 2019, traders in the crypto space were raising eyebrows at Alameda's seemingly supernatural ability to be on the right side of every major move. The returns were too consistent. The positioning was too perfect. The whisper was that Alameda had information advantages that no legitimate firm should have, which, if you're being precise about it, was true, because the information advantage was that Alameda was using your deposits to place its bets and didn't have to worry about losing, because if things went wrong, there was always more customer money where that came from. Nobody filed a formal complaint. Nobody sent a memo to the SEC that triggered an investigation. The warnings dissolved into the noise of a market so new and so loud that skepticism looked, from certain angles, like jealousy. If you're finding this story as surreal and maddening as it deserves, subscribe, because we're just getting to the part where it all falls apart. It is November 2022. CoinDesk publishes a story. It is not, on its face, explosive. It's a relatively dry report on the contents of Alameda Research's balance sheet, leaked to a journalist. The balance sheet shows that a huge portion of Alameda's assets are held in FTT tokens, the same tokens that FTX created, the same tokens whose value depended entirely on confidence in FTX. The circularity is so complete, it's almost elegant. Changpeng Zhao, CZ, the CEO of Binance, FTX's largest rival, reads the article. And then, publicly, on Twitter, he announces that Binance will be selling its FTT holdings. It's a business decision, he says. Risk management. And, yeah, it is also a torpedo. The market reads the announcement the way markets read everything, as a signal. If CZ is selling, something is wrong. If something is wrong, everyone should sell. And suddenly, FTX is facing $6 billion in withdrawal requests in 72 hours. $6 billion in 72 hours. They didn't have it. The accounts froze. The withdrawals stopped processing. Customer service went dark. On Twitter, SBF was still posting. FTX is fine, he wrote on November 7th. Assets are fine. He used a phrase borrowed from a meme. He deployed casual language into a catastrophic silence. 2 days later, FTX filed for bankruptcy. The sequence from CoinDesk article to bankruptcy filing took 9 days. 9 days to collapse an empire that had taken 3 years to build and that the entire industry had spent those 3 years using as proof that this was all legitimate, that the future was here, that the math was real. The math was not real. When the new CEO arrived to sort through the wreckage, John Ray III, the restructuring specialist who had previously handled Enron, he issued a statement that has since become one of the more remarkable documents in corporate history. He had never, in his career, seen such a complete failure of corporate controls. There were no proper books. There was no accounting department. Expenses were approved via a messaging app. Loans were recorded in software designed for personal finances. $8 billion of customer money was simply absent. And while Ray was sifting through the wreckage, the human cost was quietly assembling itself in spreadsheets nobody was televising. A retiree in Florida who had moved a portion of his savings into FTX because his son had told him it was safe. A small nonprofit in California whose operating funds were frozen on the platform. A 24-year-old in South Korea who had taken out a loan to invest, watching the number on his screen go from real to theoretical to gone over the course of a single November week. These were not the institutional players. These were the people at the bottom of the architecture who had been told the architecture was sound. $8 billion is an abstraction until you divide it by the people it used to belong to. Before we get to the verdict, drop a comment and tell me, at what point would you have gotten out? When would the red flags have been enough? The arrest came in December 2022, the Bahamas. Again, SBF was taken into custody at his apartment and extradited to the United States. The trial began in October 2023. What made the trial strange, what made it different from the long, protracted denials of someone like Bernie Madoff, was the testimony. SBF's closest collaborators, including his girlfriend, including his co-founders, took plea deals and took the stand against him. They described a system that was not accidental. They described conversations in which the movement of customer funds was discussed explicitly. They described a spreadsheet, internally called HIDE, which allegedly existed to track the funds taken from customers in a way that wouldn't appear on the public-facing balance sheet. SBF took the stand in his own defense. He said he didn't know. He said it was a math error, essentially. He said the accounting was messy, but the intent was good. He said effective altruism. He said he was trying to save the world with the money. The jury deliberated for 4 hours. Guilty on all 11 counts. March 2024. The sentence, 25 years. Not 150, like Madoff, but 25 years, which, at 31 years old, is a number that lands differently. The judge said SBF had known what he was doing. The judge said the harm was not abstract. The judge said that the people who lost money were not collateral damage in a failed experiment. They were victims of a deliberate choice. The courtroom was quiet. For the first time in years, the man who had never seemed to stop moving, never seemed to stop posting, never seemed to stop performing the character of the reluctant genius, was still. And here's where it would be easy to call it closed. To say the system worked. The fraud was caught, the fraudster was sentenced, the lesson was learned. But the curtain is still hanging. What happened to the companies that wrote the checks without asking harder questions? Sequoia Capital quietly deleted its glowing profile of SBF from its website, a profile that had described him, in earnest, as a future trillionaire. But the fund itself absorbed the loss and moved on. The venture capital ecosystem did not fundamentally change its due diligence standards. The celebrities who had appeared in FTX advertisements, Tom Brady, Steph Curry, Larry David, settled civil lawsuits for undisclosed amounts and also moved on. The regulators who had welcomed SBF to Washington, who had posed for photos with him at fundraisers, who had treated him as a partner in the project of bringing crypto into the legitimate fold. They issued statements and also moved on. The system that allowed this, the regulatory vacuum, the venture capital firms that wrote 8-figure checks without demanding audited financials, the media that put this man on covers with captions about the next JP Morgan, the institutions that moved pension money into a Bahamas casino because the guy running it seemed smart and earnest and a little disheveled. That system did not go to prison. That system is still operational. That system is, right now, evaluating the next pitch from the next person with a physics degree and a theory about doing good while getting very, very rich. The $8 billion number is not really about Sam Bankman-Fried. It's about what we need from people who speak the language of the future with enough confidence. We need them to be right. We need the numbers to be real. We need the math to hold. And when someone comes along who sounds certain enough, who has the credentials, who has the backing, who has the beard and the beanbag and the earnest TED Talk cadence, we lower the drawbridge. That's not stupidity. That's human. But it is exploitable. It always has been. and the structure that makes it exploitable, the deference to perceived genius, the institutional reluctance to ask a simple question twice, the cultural mythology that says disruption justifies its own chaos. That structure predates Sam Bankman-Fried by centuries and will outlast his sentencing by centuries more. Bernie Madoff built his con over 40 years and hid it behind a legitimate brokerage, a NASDAQ chairmanship, and the quiet confidence of an older generation's trust in institutions. SBF built his in 3 years, in public, on Twitter, with a media strategy and a political donor network and an ideology dressed up as a personality. The technology changed. The speed changed. The scale changed. The con did not change. The courtroom is empty. The curtain is still there. And the next wizard is already counting. If this story left you with more questions than answers, good. Share it with someone who needs to hear it. And the next time someone promises you the future with no fine print, remember the man who already sold it. $8 billion at a time.